Let's bring in Bernstein senior analyst Tony Sacconaghi for his tech take. Tony, as always, good to have you with us. I'll start with that general question. Is tech and growth, are they taking a breather?
Good afternoon, Tyler. I think they are. We've had a spectacular tech run-up year to date, as you mentioned. And when we look at technology valuations, they're trading at collectively at about a 40% premium to the market. The historical premium for tech is about a 25% premium to the market. And yet tech earnings this year are actually supposed to grow more slowly, and revenue is supposed to be more slow than the broader market. So you have elevated valuations and you have expectations for weaker relative growth for technology. And I think as we get into earnings, investors are processing that and pausing and saying, look, does it continue to make sense in an environment where the macro is questionable and where we have relatively elevated valuations and some questions about the relative growth rate?
So that's the broad sort of 50,000-foot view. Let's bear down on a couple of stocks that you follow that are very popular in a lot of people's portfolios. They probably own them if they own mutual funds. They certainly own them if they own index funds. Let's start with Apple and your thoughts there.
Sure. So, Apple is an incredible company and has a dominant consumer franchise. As an investor recently very articulately said, they have a monopoly on the most important thing, or nearly the most important thing in most people's lives. And that's a pretty powerful franchise. That said, if we look at Apple's valuation, it's trading at about 28 times this year's earnings. The market's a little bit around 20%. So we're looking at a 40% premium, which is about the highest premium that Apple has ever traded at. And this year, consensus expects revenues and earnings to go down. Apple had a spectacular last few years. I think this year and potentially next year will be digestion years. So you have the same dynamic that's happening in the overall market, which is you have Apple at nearly its peak relative valuation of all time, and yet you're going to have more muted growth this year. And so I think investors are trying to assess that trade-off.
So, Tony, this is such an interesting point because obviously one of the reasons why people were in tech was this idea that you want to be with the growers in a lower growth environment and that kind of thing. Is it possible that tech's just going to take the year off and then go back into revenue growth leadership or earnings growth leadership, because this year they're just kind of catching up to the downside like they led on the upside post-pandemic? So if people stick with the stocks, will they be rewarded over the next 24 to 36 months, even if they're not in the near term?
Right. Well, I think it's a great question, Kelly, and you're right. So for this year, tech earnings and revenue growth are supposed to be below the market. For next year, they're supposed to be above the market. But what's interesting to me is when we look out 5 years and we look at tech earnings growth over the next 5 years, it's about a 2% premium to the market. Historically, the 5-year growth rate for tech is at a 4% premium to the market. So again, when we look out near term, the next year, and longer term over the next 5 years, earnings and revenue expectations for tech are more muted, yet we have these elevated valuations. And that is something that does concern me as we look beyond just the near-term trade on technology.